Hi everybody, welcome back to the course. Let's get started on fundamental analysis. What is that? Fundamental analysis gives us a weather report about the overall economy, which is macro, the big things, or the individual companies, which is the small things, the micro things. We're going to look at the macro side first. Macro moves the market. Micro moves the stock. But stocks do move in packs, so we must pay attention to both the macro and the micro. So starting with the macro, I'm going to introduce you to a website that I really like. It's called forexfactory.com. And on the home page there in Forex Factory, they keep a calendar. This is a really good high-quality calendar that explains to you what different news events are about to occur, not just for the United States, but for other countries as well. That's becoming increasingly important, right? Especially Europe and China news tends to move the US stock markets now. So really, it really is becoming a global marketplace, and we need to follow not just things that are occurring in the US, but things that are occurring outside the US that are going to affect the stock market. How does it work? These different individual economic indicators, I want you to think of them as if they were little report cards for different sectors of the economy. So you might have a report card for the factory sector, right? We look at factory orders. We have a little report card for the construction sector. We look at construction spending or building permits, right? All of them are telling us something about a part of the economy. They're like little pieces of a puzzle. We put those pieces together, and then we can see the big picture where the economy is heading and what's going to move the market. So now, all the major banks and brokers hire these analysts. They hire a lot of them right out of school, and they train them to analyze these macro events. And the whole idea of spending, they're investing a lot of money in these analysts. The whole idea of doing that is so that they can try to figure out what is going to be the result of these reports before they occur, before they're announced. Because if they can figure it out ahead of time, then they can place the trades ahead of time and profit from the moves in the market ahead of time. So we've got all these analysts, right? They work very long hours, especially the new hires. And they're well compensated, but believe me, first year or two, you have no life whatsoever, right? They're working for the big banks and brokerages on Wall Street. Now, these analysts will be surveyed, right, by a news organization like Reuters or Bloomberg, right? We'll send them a questionnaire. Hey, where do you think GDP is going to come out for the second quarter? Where do you think factory orders are going to come out? And what they do, these news organizations survey the analysts, and they come out with a forecast. They sort of throw all those analyst reports into a hat, and they sort of average it out. And they come up with what we call a consensus forecast. So we'll say, okay, the market is looking for X. And if we get higher than X, if we get something better than X, the market tends to respond positively. If we come out lower than X, the market tends to respond negatively. Now, on this shot, you can see certain things that have come out better than forecast, highlighted in green under the word actual. And you can see some things that came out worse than forecast, highlighted in red under the word actual. Okay, so you can see the forecast right there in the middle. That's your consensus forecast. The green ones are the ones that beat the forecast, so that's like a good report card, right? And the red ones, they're the ones that missed expectations. They're like bad report cards, but it's all a matter of degrees, right? You can come out a little bit better than expectations. That might be a mild positive. But if you come out much better than expectations, that can be a big positive and can have a very immediate impact on the market. So it's that expectation of that consensus forecast that creates the move, because it's the expectation really versus the reality. Let me show you what I mean. Okay? Every month, there's a consumer sentiment report, right, out of University of Michigan. In this particular case, it was expected to read 78.1. That was the consensus forecast. However, the actual result was much better, much stronger, 83.1. So that's not just a little bit better than 78.1, that's a lot better. So how did the market react when that news was released at 7:55 a.m.? If you take a look at this 1-minute chart of the SPDR, which is an ETF that mimics the S&P 500, you can see the moment that that report was released, the market just lifted off. Big rally, right? Begins right at that moment. So you can see the type of impact that these reports have. Some of them are released before the market opens, and some occur, such as in this case, while the market has already opened. Those are the ones you really have to watch out for. Now on Forex Factory, we actually group these different little reports according to the impact that they may have on the market. In other words, if you see that one is marked yellow, like that 30-year bond auction, that data is not likely to be a big market mover. Okay? We colored a little deeper, right? We got an orange color for the IMF meeting. That's a medium impact. That has a chance to have an impact in the markets. And when you see it listed in red, right, that's going to have a strong impact on the market. So if you want to dig a little deeper and learn a little bit more about the data, it comes with a little detail link. So you can see there retail sales year over year, and the red arrow is pointing to a little link. You click on that link, and it's going to give you all this information, different news stories, different trends are all going to be listed under there. Okay. Now, economic calendars are free and they're freely available. They're on many websites such as thestreet.com, briefing.com, FX Street, Yahoo, NASDAQ.com, Bloomberg, MarketWatch, FinViz. It's just a few. I mean, there's so many of them. Okay, and but again, you don't only want to look at U.S. data. You want to look at data coming out of China. You want to look at data that comes out of Europe. Probably the question that I am asked most often in conjunction with these reports, everybody wants to know which ones matter the most. That answer to that question changes based on the state of the economy. Okay? Different things matter at different times. I'll give you an example. Back in 2005, nobody was really concerned about housing data because housing was in a bull market and the economy was roaring. We didn't care about the housing numbers. We cared about inflation because everyone was afraid that the Fed was going to start raising interest rates. And so that's what we watched the most. We watched inflation. So inflation is tremendously important in a bull market, or in a strong economy, perhaps would be a better way to put that. But by 2012, the housing bubble collapsed. So we didn't used to care so much about housing numbers, but by 2012, we cared a great deal about housing numbers. They became maybe the most important thing. We cared very deeply about housing, and nobody cared about inflation. Okay, so when the economy is really bad, we don't really worry about inflation all that much. But housing becomes very important. Why is that? Think about all of the things that you have to purchase in conjunction with a house, right? You buy a new home, and that home is going to have a new washer and a new dryer and a dishwasher and all these other components inside of it. Okay, so you're really generating business for all these factories. That new home is going to have carpeting or flooring, or maybe you bought a home that's already existing and you want to recarpet it or refloor it, or maybe you have to hire a landscaper. Okay, there are a lot of different things involved in housing. And so, when housing is strong, that really pumps up other parts of the economy. So when the economy is very weak, we care a great deal about housing because there are so many different things that are connected to housing. Now, so in a strong economy, we're really concerned more about inflation. So they're looking at GDP, personal consumption expenditures. That's something that the Fed watches very closely, by the way. We're looking at retail sales, consumer price index, producer price index. Those are all inflationary numbers. Personal income, personal spending, right? If people start getting higher incomes, making more money and spending more money, that can create inflation. So when the economy is strong, we're worried about inflation. When the economy is weak, we don't really care that much about inflation. We care about two things mainly, jobs and housing. So the non-farm payroll report becomes very important in a weak economy. Jobless claims, which come out every week, becomes very important in a weak economy. ADP puts out a jobs report every month. That becomes very important. Housing starts, building permits, existing home sales, new home sales, anything related to the housing market becomes very important in a weak economy. Purchasing Managers Index becomes important in a weak economy. What is that? What's a Purchasing Managers Index? You know, every company has a purchasing manager. And that purchasing manager has his or her pulse on the company. He or she knows how many computers they're going to need, how many desks, how much equipment. You can't hire people and have them standing around. You got to have them a place to sit, right? They're going to need chairs, they're going to need desks, they're going to need computers. Some clever person got an idea and he said, you know, if we just surveyed all the purchasing managers, that'll tell us something very important about the economy. That's why the Purchasing Managers Index becomes very important, especially in a weak economy. Manufacturing is also very important in a weak economy. Factory jobs, right? Factory orders, Philadelphia Fed, Empire Manufacturing, these are very important in a weak economy. And also consumer confidence. We want to see confidence improving because that means people are more likely to spend money.